Okay, I think we can begin now. Good afternoon, everyone. Thank you so much for joining us today for our webinar, ETF Investing 101. Okay, just a little brief introduction about myself. Yeah, my name is Kenyon, and I'm a securities dealer at Longbridge, Singapore. Okay, and I'm excited to walk through ETFs with you over the next hour. Okay, before we begin, just please take a look to review the important disclaimer on this slide. Which covers the key information, including forward-looking statements, and that, this is for informational purposes only. Okay, before we dive in, I just want to give you a quick roadmap of what we'll cover today. Yeah, I'll just maybe give everyone a while to take a look at the agenda on the screen, so you can actually have a sense of, how the session will flow. Okay, so the idea is to take you step by step from understanding what ETFs are to knowing how to think about them and to use them with confidence. And by the end of this session today, so my goal is for you not only to understand ETFs better conceptually, but also to feel comfortable applying that knowledge in practice. Whether it's choosing suitable ETFs for yourself, or knowing what to look out for, or using them as part of your overall investment strategy. Okay, maybe let's begin at square one. Okay, so what is an ETF? So for those that may not know, ETF actually stands for Exchange Traded Fund. Okay, and ETF, is essentially a fund that pulls money from many investors, and they actually use that pool of money to actually buy a whole basket of underlying assets. So this could be in the forms of stocks, bonds, commodities, or even a mix. And you may be wondering, is it the same as a mutual fund? Okay, so the key difference that differentiate it from a traditional mutual fund is that you can actually trade ETF shares on a stock exchange, just like any normal stock lah. So that means you don't have to wait until the end of day for a price. You can actually just buy or sell, anytime during the trading hours when the markets are open. Okay, so why this matters is actually simple. So you actually get easier diversification, better liquidity, full transparency and lower cost. Because when you invest in an ETF, you're not just buying shares of one company, and instead, one share of an ETF actually gives you exposure to a whole basket of underlying holdings. So that means that your risk is actually spread out, and you don't have to, purposely pick and monitor, 10, 20, or 50 different individual stocks. So one ETF actually gives you the built-in diversification, and also, since that ETF actually trades on the exchanges, they offer liquidity. So you can, enter or exit a position quickly with real-time pricing. And that gives you flexibility that something many other funds don't offer. And I guess perhaps the most important one would be that ETFs actually feature a creation and redemption mechanism. So this actually means that the big institutions, the authorized participants, actually help keep the ETF market price tightly aligned with the real value of the underlying holdings, by exchanging the basket of securities in and out of the fund. This is something that I will elaborate more on in a moment lah. Okay, so before we actually explore the different types of ETFs, so let's just take a pause to actually think about something that truly matters, which is your reasons for investing. Okay, I understand that it may sound, cliche and, simple, but actually being clear on your goals can actually make a big difference, when choosing the right ETFs. You got to ask yourself if you are aiming for long-term growth, saving for retirement, generating income, preserving your capital, or a mix of all these. So actually knowing your purpose will actually help guide every choice you make. Okay. It's also worth, thinking about your time horizon. You know, for example, short-term goals, may call for safer, like lower volatility assets, while long-term goals can actually benefit from broad and diversified ETFs that actually help smooth out the market up and downs. Okay. And of course, your comfort with risk matters too. So some people are okay with short-term swings for higher potentials returns, while others may prefer stability and the peace of mind. So I actually wanted to highlight this upfront because being clear on your goals, time frame and the comfort with risk actually give you a strong foundation as an investor. So when you understand, what you're investing for, the choices actually become clearer, and it's actually much easier to select ETFs that truly suit you with confidence and intention. Okay, and with that in mind, let's move on to the different types of ETFs. Okay, so ETF, comes in many flavors. Okay, and understanding these categories will help you match the right ETF to the goals that we've just mentioned. So the main common categories, starting with equity ETFs. Okay, so for equity ETF, they actually track a basket of stocks, often via an index such as, S&P 500 or so. So they also track the index or a selection of companies and can vary by the market capitalization, investment style, such as either growth or value, strategy, also the geographic or regional exposure and sector or industry focus. So equity ETFs are actually more useful for broad market exposure, and long-term growth, or maybe if you want to tilt your holdings, towards a specific industry, region, or investment style. Okay, some examples for equity ETFs would be for the counter code would be like SPY that actually tracks the S&P 500, and then for VOO, Vanguard to actually for some S&P 500 exposure. Okay, and moving on to the fixed income bond ETFs. So they actually invest, in portfolios of bonds rather than stocks. And they can actually differ by the bond maturity, issuer type, credit quality, the yield, and geographic or region. Okay. So this is more suitable for investors, seeking regular income, lower volatility, or a stabilizing component in a diversified portfolio. Okay, so some common bond funds for the income and stability would be uh, AGG, BND, and TLT lah. Okay, and then on to thematic slash sector ETFs. So thematic ETF actually invest according to long-term themes, mega trends, or cross-sector ideas, such as clean energy, AI, aging population, and so on. And it's not just by industry classification. Okay. So the sector ETFs actually target a traditional industry like technology, healthcare, financials, and it will be good for you, if let's say you strongly believe in a particular, long-term trend or industry. Like example, these days the hypes is AI, right? So it actually gives you actually allows the targeted exposure, without picking individual companies. And they can also add a tactical or growth tilted dimension to your portfolio. Okay, so some examples of sector and team focus ETFs would be XLK for like the tech sector, and then XLF for the financial sector, and then XLE for the energy sector. Okay, and then moving on to commodity ETFs. Okay, so these actually give you exposure to commodities. Okay, so for those that may not know what commodities are, they are actually precious metals, oil, agriculture, and etc. So they give you exposure to commodities without, having to actually directly buy or store the physical commodity. Okay, and the structures also vary, some may hold the physical commodity assets, and others can use futures or derivatives, depending on the fund. So this one would be good, if let's say you want to hedge against inflation or currency fluctuations, and can actually add diversification beyond stocks and bonds, or if you would like to gain exposure to the commodity price trends. Okay, some commodity exposure for ETFs would be GLD for gold, and then SLV for silver, and DBC for broad commodities. Okay. And for the currency ETFs, I think it's quite straightforward lah. So they actually invest in a specific foreign currency, or a basket of currencies. Okay, so this actually allows investors, to actually gain exposure to the currency exchange rate movements, instead of you buying the foreign currency directly. So this ETF actually provide a way, you know, for you to hedge against the currency risk, through the exchange traded securities. Okay, and this would be useful, if you have investments, let's say, denominated in foreign currencies, and you wish to hedge against the currency risk, basically to protect yourself against the FX fluctuations. Okay. And it can also be used to, speculate on currency movements. Okay. For instance, if you expect a certain, currency to appreciate, relative to another. Okay. And it's also helpful if you want to maintain diversification, not only across asset classes, but also across currencies, adding another layer of risk return profile to your portfolio. Okay, some examples for currency ETFs would be UUP for USD exposure, FXE for Euro exposure, and then for FXY for the Japanese yen exposure. Okay, and combining, all these different types of ETFs, you can actually build a balanced and diversified ETF portfolio that matches your risk profile. Okay, so now let's talk about why ETFs are actually so popular among investors. Okay, and why many actually make them the backbone of their portfolios. Okay, so firstly would be diversification, right? So when you buy a single ETF, like I mentioned just now, you're not just buying one company stock, you're getting a chunk of a whole basket of securities, potentially hundreds of companies, bonds, commodities, or a mix. So that means if one company, let's say the or bond issuer or commodity underperforms, it has a far less impact on your overall holdings, right? ETF actually makes diversification easy. So there's actually no need to build and rebalance a large portfolio of individual assets yourself. Okay. And for low cost, many ETFs, are actually cheap to own. Okay. As you know, most ETF actually follows a passive, index tracking approach rather than, relying on the active fund managers. That typically means lower management fees and operating expenses, compared with actively managed funds. And lower ongoing costs actually means most of your money actually stays invested. And over the long run, this cost efficiency can actually make a real difference to your net returns. And then on to liquidity and flexibility. So unlike many traditional funds, ETF are listed on the stock exchange, correct? So they can be bought or sold throughout the trading day. And that gives you the flexibility. Okay, you don't have to wait until the end of day, or special redemption windows. Whether the market moves or your financial needs changes, you have the ability to enter or exit the positions quickly, which is a big advantage, when you compare that with many other pool investments lah. Okay, and then with transparency, okay, you actually get to know what you own. So one of the big strengths of ETFs is transparency, I would say, because most ETF, they actually publish their exact holdings frequently lah. Usually is daily, so you can actually always see, what's inside this ETF. So, which stocks, bonds or assets at any given moment. So, with that clarity, it actually helps you understand exactly, where your money is invested, and it actually gives you control and confidence to align your holdings with your investment goals or your risk tolerance. Okay, and then for the tax efficiency, so thanks to their underlying creation and redemption structure, and typically low turnover when tracking an index, ETF actually tends to generate the fewer internal capital gain events. So that means, fewer unwanted taxable events for you, while you hold the ETF. So this tax efficient structure can make, ETF especially attractive, for long-term investors, helping you keep more of your returns over time. Okay, and for accessibility, so with ETFs, you gain access to a wide variety of markets, asset classes, regions, sectors, or even commodities, often with a single trade. Whether you are looking to, diversify globally, explore bonds, commodities, or niche sectors, ETF actually lower the barrier to entry. So, even for the investors with the modest capital or limited time. Okay, and putting it all together, so why ETFs are often the core of investor portfolios is because, ETF combines like what I mentioned just now, diversification, low cost, flexibility, transparency, and accessibility. They often, serve as an efficient, low maintenance core holding. You know, Many investors actually build their foundational portfolio around broad diversified ETFs. And then they go on top by layering on individual stocks or tactical ideas if they desire. So for a lot of people, ETF, actually offer a set and forget investment backbone with the optional flexibility to tweak or expand over time. Okay, so now let's take a look at how ETFs actually trade. Okay, ETFs, trade just like regular stocks. Yes, they are listed on exchanges, like Nasdaq, NYSE, SGX. So you can buy and sell them throughout the day. Their prices fluctuate, based on the supply and demand, just like any other stock. And you can use the same order types that you are probably already familiar with, like a market order, which lets you buy or sell, immediately at the current price, while a limit order actually lets you set the price you are willing to accept, giving you more control. Limit orders can actually be especially helpful when the trading volume is low. Okay, but behind the scenes, there's actually this secret sauce, okay, that the make the ETFs special, okay, and that's the creation and redemption mechanism. Okay, so the large institutions known as authorized participants, right, APs, they actually play a central role here. So when the demand for an ETF, rises, an AP can actually assemble the basket of underlying securities, the ETF tracks, and then deliver that basket to the fund issuer and receive a large block of new ETF shares in return. And then those new ETF shares can then be released onto the exchange. So this is called the creation. Okay. And conversely, if ETF shares trade at a price, below what the underlying assets are worth, an AP can buy a block of ETF shares from the market and return them to the issuer and receive the underlying securities instead. And now that process is called redemption. And why does this matter? Okay, it's actually because this creation redemption process actually helps ensure that the ETF share price actually stays close to the true value of its underlying holdings. Okay, true value actually means the net asset value or NAV. And if the market price drifts too far from the NAV, the authorized participants can step in, and restore the balance. So that's a mechanism known as arbitrage. Okay, and this structure is one of the main virtues of ETFs, compared with many other investment funds. Also, liquidity in ETF actually come from two layers. So, firstly, there's primary market liquidity. Okay, because APs can create or redeem the large blocks of ETF shares, the total supply can, expand or contract, based on demand, which helps the ETF, remain liquid even when day-to-day trading volume on the exchange appears low. Okay, and second, there's secondary market liquidity. So what you as an investor actually sees, okay? So you'll be seeing the trading volume, bid and ask spreads, how easy it is to enter or exit a position, right? So this depends on how many buyers and sellers are active, and how responsive the market makers or APs are in providing quotes. And of course, things can get more complicated, and riskier under certain conditions. So, if the underlying assets within the ETF are themselves illiquid, so for instance, let's say those exotic securities, or thinly traded foreign bonds, stocks, or hard to sell assets, the creation redemption process, can become difficult, like in periods of market stress or high volatility, the APs may be less willing or able to step in. So that can actually slow or even impair the creation and redemption. And as a result, the ETF share prices might actually diverge significantly from their NAV. Okay, the bid and ask spreads can also widen, and the liquidity can also dry up. And similarly for ETFs with low trading volume, so this one would often be those niche or specialized funds. Okay, so even the secondary market liquidity can be fragile. So during the sell-offs or market panic, large redemption requests, may lead to forced selling of underlying assets, which can in turn, depress the prices further and amplify volatility. And because of this structural risk, it's actually important for investors, to pay attention to, how liquid the underlying holdings are, how actively an ETF trades, and whether the ETF are designed like the asset type, sector, region or so could actually make it vulnerable to stress. Okay, so when you hold an ETF, right, how do you know if it's doing, really doing well? Watching the share price move actually, gives you just a partial view, but to really understand, whether an ETF is performing the way you expect, you want to dig a little deeper. So there are a few things that you can check, and by looking at them together, you actually get a more clearer picture, than by just following the price charts. So let's just go through them step by step. Okay, so firstly over here you can check the net asset value or NAV. So it basically just tells you, what the underlying assets of the fund are worth per share. Okay. And then, compare that NAV with the current market price of the ETF. So if the market price stay close to the NAV, that suggests that the fund is trading fairly. Okay. But if there's a persistent gap, maybe the ETF is trading at a premium. Premium means price above the net asset value, or a discount, which means the price below the net asset value. That could be a sign, worth exploring further. Okay, and then for the next one, you can look at the total expense ratio. Okay, so this is the annual cost to actually run the ETF, such as like administrative costs, custody costs, and so on. And over time, those costs actually add up. And even, small differences in this total expense ratio can significantly affect your net returns. Okay, so all else equal, an ETF with a lower total expense ratio actually gives you a better shot at capturing the returns close to each benchmark. But cost isn't the whole story. What really matters is, how well the ETF tracks the index it aims to replicate. And that's where the tracking difference and tracking error actually come in. So the tracking difference actually shows over a given period, like how much the ETF returns have diverged from its benchmark index. So let's say you have an ETF, right? And your ETF returns 5% over a year, but the index say did 6%. Okay, so your tracking difference is negative 1% lah. Okay, ideally, you want the tracking difference to be small, close to zero if you can. So you know you are basically getting, what the index delivered. Tracking error, on the other hand, tells you how consistent that difference has been over time. So how stable your tracking is. Okay. You can think of it as the volatility of the deviation. Okay, a low tracking error means that the fund tends to stay close to the index return. Okay, and a high tracking error means you might see bigger swings. Even if the average return over time seems okay. So, why might there even be tracking differences or errors? So, some reasons are because the total expense ratio that we talked about, right? Is one of them. So higher fees, actually mean built-in drag on returns. But there are, other costs too, like trading or rebalancing costs when the index changes. You know, parts of the fund held in cash, sampling. So sampling means that when the ETF doesn't hold every single security in the index, okay, maybe the dividend reinvestment timing, all these subtle, mechanics can actually affect how closely the ETF mirrors the index. Okay, and then you can also check the liquidity and the fund size. That includes metrics like how much money is actually invested in the fund. Like, okay, so that is the AUM, the asset under management, and how actively the ETF is traded, like the trading volume, bid ask spreads, the ease of buying and selling. So, a large AUM, heavily traded ETF, tends to be more stable. It's easier to buy or sell, without big price swings or high transaction costs, which matters, if you want flexibility. And then you can also see if the ETF distribute income like dividends. So also check the yield and the distribution history. So for those income-oriented investing, the dividend yield, how often the distributions are made, and how stable they are over time can actually make a big difference to your total return and cash flow. And then finally, you can measure the historical performance over multiple years. So not just those short-term moves, you can actually look at 1, 3, 5, or even the 10-year performance and compare to the benchmark index, and maybe perhaps similar ETFs as well. So this actually lets you see, how the ETF performs across different market cycles, giving you better context. But I mean, of course, you have to remember the basic thing, which is the past performance, doesn't guarantee future performance. Okay, and when you bring all of these together, like the net asset value, price, tracking error, and so on, right? You actually get a full balance view. Okay, so that way you're not just checking today, oh, did the price go up, but actually see, did the fund do what it promised, efficiently and reliably according to how you want to invest. Okay, let's talk about ETF dividends. Okay, how they work, what to expect, and what to watch out for when you invest with Longbridge. So when your ETF, includes dividend paying stocks, the fund, actually collects income from those holdings. So that income becomes available to you as a shareholder. And typically, for many ETFs, and especially those US domicile funds, the income is paid out directly to investors, rather than being automatically reinvested internally by the fund. So what this means for you, okay, so when the ETF declares a dividend or distribution, you get to receive the cash and it will be credited to your brokerage account or or cash balance on Longbridge. Okay, so for those that may not be like some queries that we usually get, right? Like if they are entitled for the dividends or so. So here's how it works in practice, yeah. So there's a record date, right? The date by which you must own the ETF, to be eligible for the distribution. There's also an ex-dividend date. Usually, it's a business day lah, before the record date. So if you buy the ETF after that date, you generally are, not eligible for the upcoming payout. And then there's also the payment date when the cash dividend is paid out to the shareholders. So the distribution frequency, depends on each ETF. Some pay monthly, quarterly, semi-annually, or annually. And for Longbridge, we don't automatically reinvest dividends for ETFs. So you, the investor, get to receive the cash payout, and that cash gives you the flexibility. So you can actually hold it, withdraw it, or manually use it to buy more ETF shares or other investments, at your discretion. Okay, so I will now just speak to show you, like how you can actually view ETFs on Longbridge. So for those that may not have any ETF in mind, you can just follow the one that is on the screen right now lah. So the counter is called VOO. Okay, maybe you can just open the Longbridge app, right? And then go to the market tab, right? So once you're there, you can actually tap on the magnifying glass icon at the top of the screen to actually bring up the search bar. And in the search bar, you can actually just type in the name or ticker of the ETF that you want to look up and select it from the results. Okay. And after you tap on the ETF, you should see a page similar to the first image on the left over here. Okay. So on this page, you'll find key information about the ETF, including the currency it's traded in, the asset under management, net asset value, trading volume, and more. Okay, and then if you look at the first image, right, there's a red rectangle that asks you to tap on the overview. So if you tap on the overview, you'll actually see more detailed information that I talked about earlier, such as the type of ETF. So for example, in this case, VOO is equity ETF. And then you show over here, you get to see the index it tracks, the expense ratio, and then the dividend policy. So when you scroll further down, you can actually see how the ETF is diversified. You'll be able to view the asset allocation and the different industries that actually make up the ETF holdings. And scrolling even further down will actually show you the top 10 holdings of the ETF. So these top 10 holdings are the largest individual positions within the fund. So that's how you actually navigate the Longbridge app to view the ETF information, from the basic stats to the detailed breakdowns. And of course that, now you know how to find and understand the core information about the ETF in the app, right? So I'll just take a moment to, talk about something important, which is the risk and, the things to consider when investing in ETFs. So I understand that, while many ETF offers benefits, they are not risk-free. And, more importantly, how you can manage or reduce those risks to actually help you invest with confidence, right? So when you buy an ETF, you are exposed to the value of its underlying assets. So like what I shared earlier, the stocks and bonds or whatever the ETF holds, let's say if it drops in value, say due to economic downturns, sector-specific shocks, like the Trump tariffs, or broader market declines, the ETF will also fall as well. So that's market risk, okay, and it's unavoidable with any investment, tied to markets. So in this case, so how to actually manage market risk? So the best way is diversification, of course. I'm sure we all know the common saying, about not to put all your eggs into one basket, right? So instead of putting all your money into one ETF or one sector, you can actually just spread your investments across different asset classes. Some example would be maybe a mix of equity ETFs, bond ETFs, and maybe even global ETFs that cover multiple regions. Okay, so in that way, a downturn in one market or sector may be cushioned by the stability or gains elsewhere. So another important consideration is liquidity risk. So not all ETF trade with the same frequency. So large popular ETF, of course, often have a heavy trading volume, and tight bid and ask spreads, making it easy to enter and exit the positions. But some ETFs, maybe the niche or thematic ones, may have low trading volume, wide spreads or limited buyers and sellers. Okay, so that means when you want to buy or sell, you could face unfavorable price or delays. Okay, so how to mitigate this liquidity risk? Okay, so before investing, right, it's best to check the ETF's average daily trading volume. Okay, and how big the fund is. So this one you can see under the asset under management. When you trade, especially for smaller or less liquid ETFs, use limit orders, and don't use market orders, because this allow you to set a maximum price you're willing to pay lah, okay? Or a minimum price you're willing to accept, okay? Helping prevent being caught in those wide bid and ask spreads, and to also avoid trying to trade at the very start or end of a trading session, because that's when the market tends to be the most volatile. Okay, and then next there's tracking risk. Okay, so an ETF is supposed to mirror an index or benchmark, but in practice, differences arise. So these can come from management fees and all the other fees lah. You know, a large tracking error, means your ETF returns may actually diverge from what the benchmark achieves, and this could undermine your investment objective. Okay, so to mitigate this or reduce the tracking risk, so when selecting ETFs, look for those with a consistent history of low tracking error, or small tracking difference. Okay, prioritize those that use physical replication, which means that they actually hold the underlying securities, rather than those synthetic or derivative strategies, especially if you are investing for the long term. And then reviewing the ETF's performance history can help you assess, how accurately and consistently the fund track its benchmark. And also for ETFs that invest in assets denominated in a foreign currency, there is also a currency FX risk lah. So, even if the underlying assets, do well, if the foreign currency weakens, let's say relative to your home currency, your returns when converted back could be reduced. Okay, so that's why some investors could, choose the currency hedge ETFs or account for FX risk, when holding foreign denominated ETFs. So to manage currency risk, one option is to consider the currency hedge ETFs, which I mentioned. So which they actually use financial instruments to reduce or eliminate the effect of these exchange rate fluctuations on your returns. So this helps make your returns more stable in home currency terms. Alternatively, if you invest in unhedged ETFs, be mindful of the FX exposure. You know, treat currency risk as part of your overall risk profile, and consider spreading the foreign investments across different currencies or regions to actually avoid the concentration in a single foreign currency. Okay, and finally, don't forget the cost and fee considerations. So, ETF, carries costs, right? And like, expense ratio management fees, sometimes additional underlying transaction costs, also. And over time, those costs actually eat into your returns, right? Even if the index performs well, high fees or hidden costs can significantly reduce the net returns. So to minimize this risk, opt for ETF with lower expense ratios. Or else equal, the especially for broad market exposure or core holdings, compare similar ETFs and balance cost against benefits. Sometimes, paying a slightly higher fee might be worth, if the ETF offers better tracking, liquidity or diversification. And also avoid over trading, like frequently buying and selling, because these transaction costs and spreads can erode your returns. So for long-term holdings, a buy and sell approach, often works better. Okay, so when investing with ETFs, there are a number of simple but powerful habits and principles that can make a real difference to your long-term results. So here are some best practices I recommend, especially if you are just getting started. So let's start with this. So maybe you can choose ETFs that are easy to trade and inexpensive. So you can look for ETFs with good liquidity, ones that are traded regularly, and whose underlying assets are, fairly easy to buy and sell. So that reduce the risk that you'll get stuck, trying to exit a position or end up paying a big spread. And then next is smart to diversify across asset types. So instead of putting all your money, into the equity ETF, like what I said earlier, just think of spreading across a mix, equity ETFs, bonds ETF, or maybe even commodity or other asset classes ETF. So the diversification can actually help smooth out the risk. So when one part of the market suffers, another might actually hold up better. So this way you avoid the overexposure to one sector, region, or asset type. Whenever you trade, especially with ETFs that aren't super liquid, okay, use limit orders lah. So this one I already mentioned just now. So it's actually to protect you from the sudden price swings or wide bid-ask spreads. Like some market depth you're only able to see the first level or so. So if you put a market order, you might actually be paying a lot more if there's a wide bid-ask spread lah. Also, you got to think long term and avoid frequent trading or trying to time the market. So, frequent buying and selling actually tends to increase the cost, and often leads to worse outcomes, than a steady long haul approach. For many investors, holding a well-chosen ETF over the years rather than jumping in and out actually tends to, yield better results. Okay, and finally, don't just buy and forget. Review your holdings and the performance periodically. Over time, your asset allocation may drift, or your investment goals may change. So regular checkups actually help you stay aligned with your goals and make adjustments if needed. Okay, so adjustments would be like to rebalance, update your strategy or change the mix lah. Okay, and alongside these best practices, it's also helpful to be aware of common mistakes beginners investors often make when investing in ETFs. So it will be like overlapping exposure, you know, and then also another mistake would be to focus too heavily on short-term performance. I understand it's tempting to choose an ETF, just because it has performed well recently. But long-term outcomes are driven, more by factors like the cost, tracking quality, and whether the ETF actually fits your investment objective. Okay. Uh, Liquidity is another area that's often overlooked lah. So I think most people should look onto this as well. And then lastly, I think can be more careful about chasing the trends or hype without a clear strategy. So I understand that, thematic ETFs can play a role, in a portfolio, but they tend to work best as a complement, and it's not the foundation of a long-term plan lah. Okay, so I'll just briefly run through the recap and the key takeaways I feel you should take away today. Okay, so okay, ETF offer a straightforward, low cost and flexible way to invest. Okay, and by holding a basket of assets, right, they actually give you instant diversification, transparency and flexibility all in one investment. Okay, and then not all ETFs are created equal. It's important to choose ones that are low cost, reasonably liquid and aligned with your personal goals rather than chasing the latest hype or trend. Think of ETFs as building blocks for your long-term portfolio, not as tools for quick trades. Over time, consistent investing usually works better than trying to time the market. It's also key to stay informed, check what the ETF holds, how actively it trades and what the fees are and whether it still fits your goals. So periodic review actually helps you stay on track and make smarter decisions. Above all, you can use ETFs thoughtfully, when you choose carefully, stay consistent, and invest with intention. ETFs can become a strong, stable foundation for your financial journey. Okay, now, so let's talk about what you can do next, putting everything we covered into action. So maybe you can start by exploring available ETFs on Longbridge. Just take a few minutes to browse around, look for funds that match what we've already discussed, diversified, low cost, is liquid, and aligned to your goals. And then you can pick 2 to 4 ETFs that you find interesting, and can add them to your watch list. Okay, so just watching them over a few days can actually help you get familiar with how they move. And once you feel ready, you can just go ahead to try doing a small trade. Maybe invest a small amount that you are comfortable with. So the idea isn't to make a fortune, is to learn how buying and holding and watching the ETF works in practice lah. And after that, you can commit to monitoring and learning. Okay, check how these ETFs behave over time, and revisit the fundamentals like the cost, holdings, and the liquidity, and observe how the market actually affects them. So, that way you actually build experience while keeping the risk manageable. Okay, thanks for staying with me so far. Okay, now I'd like to just open up the floor to you. So if anything we've covered today sparks a question, whether it's something simple, practical, or even something you're still unsure about, just feel free to drop it in the chat, and we'll try our best to answer lah. Okay, hold on, let me look at the Q&A. Okay, I see there's a question that says, should I use dollar cost average into ETFs or invest a whole lump sum to it? Okay, this is a very common question, and the honest answer is, it depends on both your situation and your psychology. So, from a purely math mathematical point of view, if you already have a lump sum available and markets rise over time, investing earlier tends to actually give higher long-term returns. So that's because your money is invested and compounding longer lah. So, however, investing isn't just about math, it's about emotions. So, many investors, might feel uncomfortable putting a large amount of money into the market all at once, and especially when markets feel volatile or uncertain. So, that's where the dollar cost averaging can actually help. And by investing, say, smaller amounts regularly, you can get to reduce the risk of entering the market at a single, like so-called bad moment lah. And it also helps to smooth out the price fluctuations over time. So a practical way to think about it is this. If you are comfortable with the market up and down and investing for the long term, a lump sum can be reasonable. But if you're new, cautious or worried about the timing, DCA, dollar cost averaging lah, is often a good starting approach. So what matters, most isn't actually choosing the perfect method. It's I guess would be starting and staying consistent. Okay, I see one that says you mentioned to use limit orders for ETFs that are less liquid. Why could an ETF be illiquid although it's supposed to offer higher liquidity? What happens if I need to sell urgently? Okay, ETF, depend on the active participation of the market makers and of course the creation and redemption process to maintain liquidity. So when an underlying securities become illiquid or when the markets are stressed, um, liquidity for the ETF itself can dry up. So in such cases, the B&R spreads may widen, right? And the ETF could trade at a large premium or discount to the NAV. So meaning you can actually sell at a significant loss relative to the true value. So that's why when evaluating ETF, especially those niche or exotic or thin market ones, you should always check the trading volume, assets under management and the typical bid-ask spreads, before investing. Okay, I see one that says how often I should evaluate my ETF holdings once after I invested. Okay, so there's actually no fixed rule for this, but I believe that a good practice is to review periodically. So would be I for me I would suggest every 6 to 12 months lah. Okay, to ensure that the ETF still matches your goals. Okay, your asset allocation remains balanced, and that there isn't excessive concentration or drift. Frequent over trading, isn't necessary and may incur costs. So the goal with ETFs, typically is long-term investing with occasional rebalancing. Okay, I think that we are running out of time. Uh, so maybe I just wrap up quickly. So sorry if I didn't manage to answer your questions. Uh, but you can actually feel free to WhatsApp us at this number, which is 6330 3033. Okay, I say again, 6330 3033. Okay, and we will check back and get back to you with the answer. Okay, and I would like to thank you all for joining me today. I hope what you have learned about ETFs, help you take your next step with clarity. Okay, so I'd like to thank you all again. Happy holidays. See you next time and happy investing.